Evening, everyone. Thank you for joining the session. Firstly, I must thank the committee for inviting me to do this session. It's indeed a great privilege for me to be invited by an association that's at the forefront of the financial sector in Sri Lanka. So thank you for this opportunity. I think Radhini pretty much covered my background. So just a few things to add on to that. Capital Alliance is basically an investment bank, and I'm involved in the primary dealer company. Our business is completely centered around trading securities, fixed income mainly. So forming a view on the economy, understanding how interest rates move is an integral part of our business. So my involvement in terms of macroeconomic forecasting comes into play there. And for me, that's the application that I use macroeconomic data for. So when the committee first spoke to me to do this session, they wanted me to do a session on data analysis. So what I thought was, instead of doing a very mundane session on statistical techniques and things, I'm sure you already have a good knowledge of, I thought, why not talk about this in the context of economic data? Not only because I work on it, but also because as accountants, CFOs, decision makers in companies, this is a core part of the assumptions you make when you do your financial statements, when you make assumptions for your budget, and even when you make business decisions. I mean, I'm sure as currently as well, you have a view on the economy. So what I hope to do today is to give you a structure or a framework to think about what you already do in a more structured manner by looking at the data as well. So, but I don't think there's enough time to go into a lot of technical detail on how to forecast each indicator. But what I want to do is give you a full picture of the economy, of the different indicators, how they move together, how they influence each other, and why this is important in the context of businesses and in the context of accountants and CFOs, on how you make your assumptions. So let's just start off then. So basically, the main topics I'll be covering are the role of monetary and fiscal policy in the economy. What are they? Who decides monetary policy? Who decides fiscal policy? What impact does it have on our day-to-day lives and on our businesses? From that, we'll pass on into the key economic indicators that these policies influence. What are those indicators? Where can you find the data for those indicators? And then the most important part is, how do these indicators move together in the economy? How do they form the world we live in, or the impact on the country? And I'll be touching on this, the fourth point, as we go through the whole presentation. Why in the last 2 years it has completely changed how these things normally function. So if we look at how you would expect these indicators to move normally, the last 2 years, because of COVID-19, obviously it's completely changed how economies function and how these indicators move, which is a very important point. So getting right into it, the role of monetary and fiscal policy in the economy. So what is fiscal policy? Fiscal policy is essentially decided by the government, by the parliament. It is the policy that is adopted on public financing and public spending, basically the budget. What I've shown here, I don't like to show a lot of numbers. So I know this is a few numbers, but the main line item I want you to focus on is highlighted in red, which is the overall fiscal surplus or deficit of the country. What this means is, in the budget, obviously the government has revenue, the government has expenditure. If the government is spending more than it earns in revenue, this fiscal balance is going to be a deficit. And that's why it's shown as a negative number in red here. So in terms of revenue streams, tax revenue is one major component for the government. And in terms of expenditure, government employee salaries, interest expenditure, these are the expenditure you have for the government. So why is this number important? And as you can see, I'm just looking at 2018 through 20, and you can see that it's been increasing. When this number becomes more and more negative, what does it mean? It means the government is spending more than it earns. It can do this by increasing its expenditure, and reducing its revenue. Why? What impact does this have? In very simple terms, this results in the general public having more disposable income, or the general public receiving more spending power. For example, if you cut taxes, you and I as individuals, as well as companies, will have more disposable income. We are paying less taxes. On the other side, if the government is spending more by giving handouts like Samurdhi benefits, or increasing government employee salaries, those individuals will have a higher disposable income. So to what end is this expanding budget deficit? It is to the end of stimulating economic growth. So when we have more disposable income, we will go and buy more goods and services, and it will stimulate the economy. So this is what is known as expansionary fiscal policy, where the government is spending more money to stimulate economic growth. That is the key objective of expansionary fiscal policy. And obviously, the opposite of this is contractionary fiscal policy, where the opposite of this happens and the government reduces its spending. So two key points about this fiscal deficit. Firstly, how is it financed? So I'm just bringing your attention to the financing sources of the Sri Lankan fiscal deficit over the last 20 years. So the first, I'm going to break this graph into three. Don't get too overwhelmed by the numbers, but the basic point here is between 2000 and 2010. If I draw your attention, you can see that most of it has been domestically financed. So almost only 20-25% has been foreign financing of the budget deficit. Between 2010 and 2015, the foreign financing component we see has now increased to about, on average, about 40%. And then between 16 and 18, we see it's a much higher component. So what are the implications of this? What does this mean? So in a expanding budget, expansionary fiscal policy, the government requires more funding. How does it obtain this funding? The government issues treasury bills and bonds to the public. The banking sector subscribes for this, and the government borrows money from the public to finance this spending. So what happens when the government needs to borrow more during an expansionary fiscal policy? It means that there's more demand for government borrowing from the public, and this basic supply and demand factors make that the cost of financing for the government should increase. And that's sort of one way of thinking about how fiscal policy impacts interest rates. So the government borrows more from the public, it needs to borrow at a higher and higher rate. That is essentially what I am highlighting in this infographic. So basically what I just explained is summarized here. Expansionary fiscal policy by the government means a higher budget deficit. A higher budget deficit means it needs to borrow more from the public. When it needs to borrow more from the public and natural demand and supply factors will require that the public demands higher interest rates. So this is just one way of looking at the economy. In economics, there are so many different schools of thought, competing schools of thought. So there are a lot of different ways of looking at it. In the interest of time, I'm just going to look at this aspect. Obviously, there are different views on this. So this is just looking at how fiscal policy impacts interest rates in the medium term. Sorry, one second. Okay, so then moving on to monetary policy. What do we mean when we talk about monetary policy, and who conducts monetary policy? So as I said, fiscal policy is in the hands of the parliament, and monetary policy is in the hands of the central bank. The central bank, and to understand how they conduct monetary policy, we need to understand the objectives of the central bank. And I've highlighted the main objectives of the central bank here. And for this session, the first objective is the most relevant, which is maintaining economic and price stability of the country. So when you have expansionary fiscal policy, people have more spending power, demand increases in the economy, economic activity increases. What happens when naturally demand increases? Prices increase as well. So as you know, when the demand for any good or service increases, prices increase, and the role of the central bank is to maintain prices within a certain target range that they design. In the case of Central Bank of Sri Lanka, that is 4 to 6% inflation. So to this end, they will either use expansionary or contractionary monetary policy to control prices. And how do they do this? They do this through interest rates. So the central bank's tools that it has to conduct monetary policy are its policy interest rates. Policy interest rates, where it can either increase the policy interest rates that then follow through into the banking system. In contractionary case, it can increase interest rates, and then the banking lending rates and deposit rates will then in turn increase, and this will trickle down into the economy. And in this school of thought, the impact that this has on the currency is also when interest rates increase, we expect more dollars and FDI inflows into the country and the currency to appreciate, and vice versa. So I'll talk about this transmission mechanism in detail a little later. So right now, I just want to highlight the fact that what are the objectives of the central bank? How do they achieve these objectives? What are the tools they use to achieve these objectives? One more point I actually missed on fiscal policy is, this is how fiscal policy usually works in the normal economy. Now, you might ask the question, why has expansionary fiscal policy not led to higher interest rates over the last 2 years? And the answer to that is, now we have been through a 2-year pandemic, and the conditions in the economy are completely different. Not just in Sri Lanka, but globally, we see a lot of expansionary fiscal and monetary policy. So what this means is central banks and governments keep interest rates low, even though budget deficits are expanding. Why? Because the global economy has come to such a standstill because of COVID that it requires such a strong force in terms of policy intervention to stimulate the economy. So this is one example of how traditional thinking of economics is not functioning in its proper way currently. So I'll touch on that a bit later as well. Okay, so now we've spoken about monetary and fiscal policy, and from that, essentially, the key takeaways are, how do these policies impact key economic indicators that matter to us in day-to-day business and our day-to-day personal lives as well. So what are these indicators that we should look at? So I broadly highlighted 4 indicators, and under each of those, there are a couple of sub-indicators as well. So let's start with interest rates, and the average rate. Under interest rates, we have a few interest rates. So the average weighted prime lending rate is what we refer to as AWPLR. This is essentially the average weighted lending rate at which banks lend to prime customers. And similarly, we have the AWFDR, which is the average weighted fixed deposit rate. This is the weighted average of fixed deposits that banks take. And then we have GSEC, which refers to, it's a shortened form for government securities and international sovereign bonds. Government securities reflect at what rate the government is borrowing from the general public. And international sovereign bonds, talking about US dollar bonds that the government raises, that relates to country risk premium and a different aspect that I won't touch on too much today. So essentially, these are the main interest rates that we have in terms of data. You can find most of this data on the central bank website, cbsl.lk. So why is it important to form a view on interest rates for you as accountants, as CFOs, as decision makers in companies? Obviously, your financing cost, your financing income is directly related to interest rates, and you probably already form a view on interest rates. So if you have a view that interest rates are at a low right now, and you expect interest rates to increase, in terms of decision making, you might want to lock in long-term funding right now at lower interest rates. So this is one critical application in businesses. As individuals, all of us, I'm sure, lending rates have come to historic lows over the last 2 years. So many people have been taking home loans and personal loans. So these are the day-to-day applications in day-to-day life that we will use this kind of forecasting for. If we move on to exchange rates, we're talking about the LKR USD rate. Factors that influence this, such as our foreign reserves, our balance of payments, Why is this important? Obviously, if you're in trade, if you're in an importer or exporter, you will have to form a view on the currency. If you expect a large depreciation, you would want to hedge some of your position using FX forwards. So how would you know? So you would know whether you're expecting a big depreciation or not by attempting to forecast what the exchange rate would be next year. So that would be an application that I can think of in terms of your role as accountants or CFOs. And then obviously inflation. The main inflation index that we use in economics in Sri Lanka is the Colombo Consumer Price Index, which is CCPI. All this data is available on the central bank website. How is that? How is inflation important? Obviously, your cost of sales, your input costs as a business will depend heavily on what's happening with prices. And over the last 2 years, we have seen prices go up significantly, supply chains coming under a lot of pressure. So a view on inflation and prices is critical to how you forecast your financial statements and how you make decisions. And most importantly, GDP. GDP, most of your sales data is directly linked to GDP, and that's probably the assumption you use. Under GDP in Sri Lanka, there are quite a few sub-indicators where you can use to get an idea of how the GDP grows. So, for example, credit growth is one good sub-indicator, which gives you an idea of how the GDP will be going. Now that we have an idea of these different indicators, let's take a look at how they interact in the economy, how they move together, and how they influence our day-to-day lives. Okay, so if you're like me and you like charts, you're going to enjoy this section. If not, don't worry. Basically, it's a lot of lines and numbers, but the takeaway is a story of how our economy functions over the last few years. And hopefully, I'll be able to hopefully I'll be able to get that point across to you rather than focusing on the lines, the numbers. Okay, so the first point I want to highlight is the graph on the left. The graph on the left, we are looking at interest rates. Basically, the first point I want to highlight is we have all these different interest rates, deposit rates, lending rates, but they all move together. And when I say they all move together, what I mean is in the big picture, right? You might have certain fluctuations between certain interest rates at points, but the overall picture, when interest rates are going up, all interest rates are going up. When they're coming down, they all come down together, and vice versa. The level is different, yes. The speed with which it comes down and rises is different, yes. But overall, interest rates move together is the first point. The second point is the fact that interest rates are cyclical. You can see there are several peaks and troughs that go through the last 15 years. This is not coincidence. This is purely because interest rates are linked with the business cycle or the economic cycle. And we will be getting to that point in a bit. To understand how a cycle functions, we just need to pick a point in the cycle when we start. So let's just start by looking at 2010. Okay, so 2009. On this graph, I'm going to bring your attention to credit growth, which is an indicator of economic growth or GDP. In 2009, look at the conditions. May 2009, we are looking at very low economic activity. We are looking at negative credit. In 2009, if we go and look at what's happened with interest rates around this level, around May 2009, interest rates have now fallen drastically. Interest rates from a peak of 20% have now dropped in that period close to 10%. What impact has this on the economy? Let's look at going forward from 2009. That drop in interest rates has stimulated the economy. Why do I say that? You can see these blue bars building going into 2010. These blue bars are getting bigger, taller, and more clustered together. You're seeing a lot more economic activity. People are borrowing more. Why? Interest rates are low. It's very similar to what we are seeing in the last 2 years. When interest rates are low, people want to borrow more, people can spend more, and you have more economic activity going forward. So that credit growth is booming at this point. So that's the first point. We can see 3 distinct cycles here: 2006, 2010, and 2015. So now, as credit is booming, now this is the conundrum that policymakers face. They want economic activity, but with economic activity, what do you get? You get price increases as well. And central banks are extremely afraid of hyperinflation, excessive inflation. Why? Because excessive inflation can lead to a crash in the economy. If prices increase by 50% or something, there could be a huge crash in the economy, and you can go into a deep recession. To avoid that, as I mentioned, the central banks need to pull back prices. Now, you can what you see happening here. This green line is inflation, and it's linked to this right-hand side axis with economic activity with a small lag. Okay, after about a year, you see prices have drastically increased in 2012. Prices have come up to 10%, right? Now, in this case, the central bank will have to act and increase interest rates and bring prices back down. That is essentially what we are seeing. If I move on to the next slide, we can look at what was central bank action relative to these price increases, which is what I'm highlighting. Okay, we are looking at the green line increasing. We look at the central bank policy rates increasing stepwise here. So central bank has hiked rates in response to this inflation. If you look at the inflation in 2016 and 17, also you can see this stepwise increasing of the policy rate. Central bank, in anticipation of the inflation, has started hiking rates even before inflation has taken off, because you have to act before if you want to counter inflation. So what happens when central bank increases interest rate, their policy rate? Banks then increase their lending rates, right? There's a natural demand and supply factor here as well. People are borrowing more and more. Banks can increase their lending rates, increase their margin between the deposit and lending rates. And it comes to a point where interest rates increase. Okay, let's focus on this chart now, where we're looking at interest rate and we're looking at private sector credit also in blue. So we stopped here last. So now economic activity is picking up, and now banks are increasing interest rates. Central bank is increasing interest rates. At one point, suddenly interest rates are close to 15%. Okay, you and I now as consumers and businesses are hesitant to borrow at 15%. Our cost of funds is too much. Okay, we're not going to borrow as much. We're not going to spend as much. We'd rather put deposits, fixed deposits in the bank. You'd rather lock in a 15% interest rate in the bank. Okay, you're saving more, you're spending less. Demand drops. Demand for credit drops. So you can see these blue lines getting short and short as a result of this interest rate increase. What happens when the demand drops? Prices drop. Basic demand and supply, this is how it functions in the economy. So this is why we have economic cycles. It's a constant tug of war between trying to keep economic activity up and then pulling back prices as economic activity goes. Yes, so basically this is, I hope I was clear on how these cycles function, and I'm sure you have a good understanding intuitively about how these things function in the economy. But when you look at it in terms of data, you formalize the process. I'm sure you already know these things, but when you look at the data and you look at the relationship statistically, now you could do a regression, you could do different statistical analysis on this. You might find relationships between these different indicators where you're able to forecast an indicator with a certain amount of accuracy. And you can say, this is what the interest rate will be at this point. And that's where the value in this lies, aside from just having a general idea of, oh, interest rates might increase going forward. Okay, so one last point I want to touch on is the model that I am presenting today on the economy. And I was talking about the exchange rate and how the interest rate is directly linked to the exchange rate in this model, specific model. There are different models with different views of how the exchange rate is impacted. This graph might be a bit confusing on the right-hand side. Essentially, in red, year-to-date depreciation. For each year, from 1st of January to today, how much has the currency depreciated in percentage terms? So that's why you see these sudden spikes, because the currency would have suddenly depreciated in September 2015. And that's why you see a sudden jump. And then the red line finishes here because that's the end of 2015. Then again, 2016, you start from zero. This is because generally in business terms, we talk in year-to-date depreciation of the currency. If you want to look at general USD LKR, you can look at this gray line, which is on the left axis. So you can see 2 years where we have had excessive currency depreciation of close to 12% one year, 10% the other year, and 2 years where we have seen less than 4%, which is low currency depreciation given our history. So the model I presented is when you have lower interest rates, currency tends to depreciate, and when you have higher interest rates, currency tends to appreciate. So if we look at this period, 2014, I'm highlighting this point, when interest rates had come to a trough there. Following 2014, we see 2 years with low currency depreciation. Sorry, following 2014, we see a year with high currency depreciation. Sorry, 2015, we see high depreciation following low interest rates. Then when interest rates had picked up in 2015, going forward, the next 2 years, again, we see low currency depreciation. So that kind of is in keeping with the model that I propose. But then the interesting point is here, in 2018, we see that even though interest rates didn't drop that much, so interest rates have dropped a little bit, we see excessive depreciation. So that is where currency becomes kind of interesting. I don't have too much time to get into detail, but there are so many other factors also that impact the currency. What happened in 2018 was there was outflows from the treasury bond market, foreign outflows. So there are other data points such as foreign holdings of government securities that we can also look at, and the relationship on currency. So I hope I gave you an idea of how all of these different items fit in the general economy. So just want to quickly touch on where you can get all this data. This is all public data. I have not presented a single indicator or data point that is not publicly available. The Central Bank of Sri Lanka website is your #1 go-to data source. On the homepage, on the top panel, there's statistics. Under statistics, you get all of these sectors on the left-hand side: real, external, fiscal, monetary, financial. And even on the homepage, if you scroll down, you get this economic indicators section, exchange rate, and the data library. So it's a whole host of freely available public data. Statistics.lk is another important site, and the Ministry of Finance website is another important website where you can get data on the budget and things like that. So basically the impact of COVID-19 on the global economy, I think I touched on that as well. The main difference is that over the last couple of years, we've had interest rates being kept down, and we've had so much fiscal stimulus globally, everywhere in the world, the West, the East, purely because people have been in lockdown and economies have come to a standstill. So that's the reason why currently things are not functioning as they normally do, as we have seen over the last few years. But essentially going forward, the view now is that demand is expected to pick up globally, including in Sri Lanka. We are coming out of lockdowns. Things are we are achieving the new normal. So the expectation going forward is more economic activity, better growth. So governments and central banks around the world are trying to stimulate economic activity by keeping interest rates low and by printing money and stimulating the economy. So that sort of, I don't want to overload you with data and look at specifically COVID-19 impacts on the economy, but we can do that as well. So that's a whole other session going into detail about these things. I think that's about it from me. I hope I gave you a general idea of how things work without going into too much technical detail. I think we can go into Q&A now. Thank you.
Yeah, thank you, Sanara, for that very comprehensive and clear explanation. Usually, I'm not a person who likes economics, but after listening to you, economics seems to be so easy. I'm sure all of us here also would agree with me on that. But before going to the questions, a gentle reminder, we will be sharing the link for the feedback form. So if for you all to claim, all our participants to claim your CPDs, you all will have to complete the feedback form and submit for us. Okay, a quick question, Sanara, before going into any of the questions of our members. You were talking about expansionary fiscal policies. So expansionary fiscal policy leads into increase in interest rates. So how does this impact when it comes to the currency?
Yeah, so essentially, in this model of thinking, this way of thinking, when you have increasing interest rates, it leads to inflows in terms of dollar inflows. Like for example, foreigners might want to buy Sri Lankan bonds because the interest rate on Sri Lankan bonds is so high and attractive. So they could borrow in US dollars, convert to Sri Lankan rupees, invest at a high interest rate, 15-20% or whatever it is, convert back to US dollars and earn an arbitrage. So that's why you expect dollar inflows in terms of portfolio investments into bonds and stocks, as well as FDI. So that is the general, it's a theoretical model on how it works. Obviously, how things work are not that straightforward. There are so many other factors that come to play. For example, dollar intervention by central banks. So central banks around the world can intervene in the market and sell and buy dollars. So that the currency is not actually a free floating currency. This is a practice across many central banks across the world. So it depends on their view and their approach to managing it. So like that, there are different factors that impact the currency. But what you would expect is appreciation pressure, I would say.
Okay. That's fine. Okay, I have another question also. You explained about the interest rate fluctuations, or it's rather very vital piece of information. Can you explain how the information pertaining to exchange rate fluctuation could be used in business decision?
Yeah, of course. So for someone working in trade, I think it's critical to understand exchange rate fluctuations. For example, as an importer or an exporter, if you're expecting the exchange rate to go one way or the other, you would want to hedge some of your currency risk. So as an importer, you could always book a forward contract with the bank if you're expecting some big impact on the currency going forward. So those are kind of the business applications that I can think of in terms of if you have a view on the currency.
Okay, I think we have a question on the chat box. Okay, in Sri Lanka, we can see both fiscal and monetary policy are more focused into expansionary. Can this sustain based on the current economic status of Sri Lanka?
Yeah, I know this is a common theme these days. It's like this. My view is that it's not only in Sri Lanka that we've had expansionary monetary and fiscal policy. It's been globally. To be honest, if there wasn't expansionary monetary and fiscal policy, there would have been a high chance of the country going into a deep recession as well. It's kind of a double-edged sword. It's a very, very tricky path to navigate as to how much is enough. And whether it's sustainable or not, obviously, it's not sustainable in the long run. So at one point, it will have to become contractionary. But that point is the question. So that's not a straightforward answer there. But you have to look at the data and see exactly when you should increase interest rates, when you should reduce fiscal expansion, things like that.
Okay. There is another quick question also. Now, you spoke about different types of interest rate. For example, the AWPLR or AWFDR. So, as an accountant, which interest rate should I use when I'm trying to, or rather, when I'm trying to predict something, or when I'm trying to give a management decision, or rather help a management decision? Which is a commonly used exchange, or rather the interest rate?
So from an accountant's perspective, I would say look at the lending rates, which is the AWPLR, because obviously that is the most contextual for you in terms of as a CFO or an accountant, that will impact your borrowing cost. So my view is use AWPLR. For us, our business, we try to focus government security rates because that's how we run our prop book. We trade government securities. Obviously, what you can then do is you can look at the relationship between, if you as an accountant, you probably have historic data about your cost of borrowing. What rates did you borrow at from which banks over the last, I don't know, whatever number of years. Compare the AWPLR to that. Look at the spread between your cost of borrowing versus the PLR. See if you can draw a relationship between that. Can you assign yourself a certain risk compared to a prime customer and look at the spread? Can you then forecast if PLR is 14%, or my cost of borrowing is likely to be this much? So this is kind of how you can play around with the data. But if you want to pick one interest rate, I would say look at the prime lending rate.
That's fine. Now you have this GSEC rate, the government security rate. How will this have an impact on the other lending rates? So I'm sure that will be the primary rate where all the other rates must be rallying around. So how will that have when government, or rather how does government use that? It's government security rates.
Good question. So essentially, as I said, now the central bank uses its policy rate, right? The policy rate is as the lender of last resort. At what rate can banks borrow or lend to the central bank? So what happens in the financial system is all banks lend and borrow amongst themselves. My cash flow for the day as a financial institution, I might be short of certain amount of money. I might have extra money. What I do is I would lend to another bank. If I have excess money, I would borrow from another bank. After all of the banks settle their shortages or surpluses, there will be either excess money in this system as a whole, or the whole system will be short of money. So then where do they go to borrow this? From the central bank. So then they need to borrow that from the central bank at a specific rate. That is the policy rate. And that is how it impacts the banking system. Now, for example, if the central bank were to raise their policy rate, now as a bank, suddenly I'm short of cash. So I need to borrow from the central bank now at 8%, right? So my cost of funding as a bank has increased, right? So now to you all as businesses, if I'm lending, I can't lend at the same rate. I need to keep a bigger margin. So I'm going to increase my lending rate, right? And that's how it trickles into the lending rate, and how it impacts government security rates are also very similar. So now as a bank, I'm borrowing, instead of at 6%, I'm borrowing at 8% from the central bank. Now, if I'm investing in a government security, I want a higher return because my cost of funds is now 8%, right? So if I'm investing in a risk-free asset, or I would demand a higher return than I was previously, because again my margin has reduced. So it's about that margin. It's about the bank's margin between their asset and their liability. Suddenly they are borrowing at a higher rate, means they want to maintain assets at a higher rate, and that is the mechanism, what we call the mechanism of transmission. That's how central bank interest rates transmit into the economy.
Okay, I think that was a very comprehensive answer, Sarara. Another quick question. This is from one of our participants actually. Now, according to the current data, the inflation rate seems to be a little high, or rather, it's shooting every day. What could the central bank do about it?
Okay, so that's a good question.
I'm not putting you on spot, but maybe, theoretically, I'm sure you would be able to explain that.
Yeah, so like I mentioned, it's not a local thing. No matter how much we want to think about it like that, being completely honest, globally supply chains and prices are increasing. I'm sure all of you know prices, because this is a supply side pressure. We haven't seen demand driven inflation in Sri Lanka yet. So all of these price increases are supply side pressures. It's not that people are buying so much that that's driving prices up because people are demanding more. It's because of the supply is restricted, and that's a global problem. So inflation, and central banks across the globe have been more tolerant of inflation because of the pandemic. They know that even though they see high inflation, the economies are still stagnating. That's why they're saying, okay, we will tolerate a little bit of inflation. We are willing to tolerate inflation because people are not spending yet. So it's okay if prices increase a bit, will keep rates low so that the economy will get stimulated a bit more. That was the view for the last 2 years. The Fed, the US Fed is basically the central bank of the United States. The ECB, the European Central Bank, all of these had the same view. But recently, a couple of months, over the last couple of months, this view has changed. So we've had the Fed chair also come and say that, which is kind of like the governor of the US Federal Reserve. The Fed chair has come out and said that they no longer believe that this inflation is transitory. That means that they don't believe the inflation is just going to pass because of a supply side pressure. They feel like it's a bit more long-term inflation. So in that case, what the Fed is indicating is it is ready to increase rates faster than it was previously, because now they are concerned about inflation. So it's not a very direct action, but it is a slight change in their approach where they are ready to increase rates a bit faster than they were previously. And I think that's common across central banks, not just in Sri Lanka, globally. It's a tough situation to be in, have low economic growth and high prices. So the reason they are tolerating that inflation is to prioritize economic growth, I would say.
Okay. There was another interesting graph which you showed about funding budget deficits. So there has been a shift where the funding has moved into foreign funding from local funding. So how will this have an impact on the overall economic activities, or maybe the exchange rates, the interest rates? So how will that have, what will be the impact, and how can we derive something as accountant into our decision making on those aspects with the increase in foreign funding?
Yeah, so one indicator that I didn't bring up because in the interest of time is the balance of payments. The balance of payments is essentially in dollar terms, the country, how much dollars do we have to pay, how much dollars are we getting in, purely looking at dollars. So one thing you can look at when you think about external financing is you can look at how the balance of payments has moved over the last few years, what you expect going forward for the balance of payments. I mean, foreign financing is not necessarily a bad thing. It's just that you have to look at the balance between the two. You have to look at the cost of the foreign financing. You have to look at how the maturities come, when the maturities come due going forward. And you have to look at what the capacity for us as a country is to, increase our reserve level or make these payments. So those are kind of the things as accountants, or I would say that you can look at directly. I don't think for the financial statements, there's an application of looking at foreign financing versus local financing. It's more, what impact does that have on the economy? What impact does that have on the currency? And from that, how will that impact your company?
Okay, that's a very comprehensive answer for that. Another quick question is on the currently, I think when we see in the banking system, the most important thing is the NPL, the non-performing loans. So they are at a very high, they're actually at an increasing rate. What will that have, what sort of an impact that will have on the interest rate when banks lend, or when the government as a final resort lending? How will that have what will be that impact on that?
Yeah, so that's also another interesting data point. Again, I didn't show that. You should look at non-performing loans over the last 10 years, plot it like I have, and you will see that even that is cyclical. So it's nothing new, non-performing loans increasing. If you look at it over the last 10 years, the same thing happens with the business cycle. Non-performing loans increase and then non-performing loans drop. So the fact that non-performing loans have increased, just signals where we are in the business cycle. This is just my view again. There's no hard and fast truth on this, but this is my view on how you should look at it. And when you plot that, you will realize that when non-performing loans increase to this sort of level, the pattern is very similar to what you see with interest rates. You see when it increases to a certain level, after that, the non-performing loans sort of normalize with the business cycle.
Okay. Okay. There is another question. Just give me. Now there has been a very much demand for dollars when we look at the economy. So what will this have an impact in the future? I mean, when we are looking forward at 2022, we are moving into a new year. So how will this have an impact on businesses? This
So sorry, Radhini, I didn't catch that. Can you repeat?
Sorry, what I'm first trying to say is there is a demand for dollars in the country. Okay, so what will that have? How will that have an impact on the businesses?
How will the current demand for dollars have an impact
Dollars
on?
will have the, what will be the impact stemming from that for businesses?
So essentially, demand and supply the forces of demand and supply are applicable in any market, right? If you take any good, any service, even if you take the exchange rate, if you take US dollars, there's a natural demand and supply, and these forces act to influence the currency, which is what I was talking about at the start, right? So more demand for dollars means the cost of the dollar increases. What does that mean? That means you have to pay more rupees for a dollar. So in simple terms, that's a simple answer. When there's more demand for dollars, that's not to say that okay, that always has to be the case, for the next, I don't know, X number of years. It doesn't have to be. There are certain policy actions and certain corrections that you can make that adjust that demand and supply. But those are things that in the context of COVID and different things that you have to take as we go on.
Okay, that's fine. Another quick, an overall question. Okay, now we see with the pandemic, I think economies were down, and now I think most of the countries are building up. So they're coming out of the pandemic and they're trying to move into a normal scenario. How do you see that impact coming into Sri Lanka? The positives of the economy is building up. How will that have an impact on Sri Lanka? Because now see, yes, sorry.
Sorry, I didn't catch that. The positives of the Sri Lankan economy.
Yeah, positives on the Sri Lankan economy, whereas how in the context of the world becoming, the other countries building up on the or rather recovering from the pandemic, how will that have an impact on Sri Lanka?
Trade. So other countries recovering means demand in other countries improve. Demand for our exports improve. Demand for tourism, I mean, given that the pandemic doesn't become an issue, consumption improves. So people start traveling again. So more tourists come in. People want to buy our exports more. So that is how global demand factors into the local economy. So of course, global demand and global economies reviving is a huge plus for us locally. It's not that you can you can segregate yourself and look at it in just our country. In the context of the global economy, the global economic revival is extremely important for us as a country as well.
Another quick question. Now, most of the time, or rather, there are times where when there are budget deficit, the government tries to fund it through local banks funds. Okay, so locally obtained, I mean, you borrow from banks, the government. So how will that have an impact on the banking system when government starts borrowing to fund their deficits?
The impact is on interest rates. As I mentioned, governments borrowing to finance fiscal deficit is a normal normal process in the economy. How much is the question? So when governments have more to borrow, this will have an upward impact. Theoretically will have an upward impact on interest rates. Again, over the last 2 years, that hasn't been the case. As I said, they've kept interest rates low because the economy has come to a standstill. If not, if we were operating in normal conditions, when a government is running a large budget deficit, they need to borrow more. So they won't be printing money, they'll be borrowing it from the public. So the public will demand high and high interest rates. They practically actually how it works. The central bank has treasury bill and treasury bond auctions. Primary dealers like Capital Alliance and other banks will bid for these bond auctions. And that is how the central bank borrows money on behalf of the government. So if the central bank has to borrow more money to finance a bigger deficit, us as the banking industry would demand a higher return for us investing in government securities. Now, if we are bidding at 8%, now we will ask for 8.5 for more. So then that's how that has an impact on the interest rates. Of course, that's just one part. There are many more aspects that come into it.
Okay. So now banks, the government is borrowing, and also you see there is an increase in the NPL also. So does it mean that it's not good for the banking sector? Will there be any or rather a negative impact on the banking sector because government is also borrowing from the banks and you see the non-performing loans also increasing? How will the system work?
So the non-performing loans are completely separate issue. So non-performing loans are to do with banks lending to the private sector and the general public. The government issuing treasury bills and bonds is essentially the banking sector bidding for those treasury bills and bonds. And why is it different? There's a reason why we call treasury bills and bonds risk-free assets. The reason is that the central bank has the authority to print and settle their obligations. So we can't print US dollars, but we can print LKR. So if you have invested in a treasury bond, theoretically, the central bank can't default on your investment because even if they run out of money, they can always print and settle. So it's called a risk-free asset. That's why government securities are called risk-free assets. So the fact that the government is borrowing heavily from the public, in the sense, the impact on NPLs is a completely separate issue. That's to do with the business cycle. So to answer the question about are high NPLs bad news? It's not ideal, but the point is they naturally adjust. The natural demand and supply factors in the economy lead to those NPL ratios coming down once they reach this kind of high. So it's something you have to be aware of as decision makers in businesses, and you have to be aware of what that means for the economy and where does it go from here. But it's not something to be alarmed about, in my opinion, in NPLs being so
high. What is your opinion on the future of the policy rates, the government's policy rates? How do you look? Maybe I'll just not, maybe next 6 months, how do you think it will impact? I mean, you would have had, I'm not asking with facts, but theoretically, how do you see it with the current available data? How do you see the policy rate?
I can't comment too much on this because our business and our house view and everything is formed around this as well. But just generally speaking, I mean, you guys can put together a view yourselves based on what we've spoken about. We are seeing inflation increase. We are seeing globally central banks being more concerned about inflation. Look, I'm not saying interest rates have already adjusted up, to be honest. So government security rates have come up close to 3% over the last 3-4 months. So I don't expect interest rates to increase at a rapid pace, but mainly because of COVID-19. So governments and central banks are concerned with not letting interest rates increase too fast because they want to keep this momentum going with economic activity. But we are in that part of the cycle where we have reached the bottom and now we have already come up to 3%. This has not translated completely into lending rates yet. As I said, government security rates act first, then we see that transmit into lending rates further down. So I think we are in that part of the cycle where we have seen the bottom, but I don't expect it to increase too drastically. Radhi, there are some questions in the chat box as well.
I think I have captured everything, Sanada. I've captured everything. So I have been only asking questions from that.
Okay. There's one question about the SRR. Is it okay if I address that as well?
Yeah, no problem. You can.
So, Arosha, about the SRR, how does the SRR impact the interest rate? The SRR is called the statutory reserve ratio. It's essentially how much money the banking sector or the individual banks need to keep with the central bank. We heard about the central bank reducing this ratio, increasing this ratio over the last couple of years. What happens when they cut the SRR is, if a bank was keeping, let's say, for argument's sake, 100 rupees with the central bank as deposits, when they cut the ratio, now they only have to keep 50 rupees. So suddenly 50 rupees of liquidity is released into the market. And I'm just using 100 as an example. This is a much larger number. It's in the billions, hundreds of billions. So this liquidity gets released into the banking sector. So suddenly the banking sector, which was, let's say, at zero level or net borrowing from the central bank, now has excess liquidity. So then it's a question of, where does this liquidity go? If the liquidity goes into government securities, it brings down government security interest rates. If the banking sector is already lending strongly, if lending has picked up, borrowing has picked up, and we know that's moving, it could easily go into lending, that kind of liquidity. So that's a very tricky point. You have to carefully look at where we are and what's happening in the economy at the time the SRR is changed. But the impact it has is essentially, in the short term, it should bring interest rates down if SRR is cut, because there's a liquidity release, and that liquidity could go into government securities, and vice versa if you increase the SRR.
There is another question, Sanura. Given that the Sri Lanka's foreign reserves are depleting, there is a risk of delaying the repayment of USD-dominated sovereign bonds, which are due.
Yeah.
What if there is a delay? What will be the impact, or what will happen?
This is a complete another subject. Looking at sovereign, so what that question means is essentially a sovereign default, where you don't pay on the day of a sovereign bond, or you delay a payment of a sovereign bond. Sovereign defaults are a whole other topic. It's a subject on its own. There are experts who study this and who consult on this as a complete field in itself. It's not a new thing. It's a very common thing, in fact. Over the last 2 years, we have seen, I can't remember the exact numbers. I have looked at about 10, 20 countries that have defaulted in the last 2 years itself, including Ecuador, and the big names: Ecuador, Venezuela, Argentina, Greece, over the last couple of years. If you look at these economies and those specific incidents, you can look at different impacts on the economy. It's very hard to say, okay, if there is a sovereign default, this is exactly what will happen, because all countries are different. How trade happens is different. The currency is different. For example, Ecuador is a dollarized economy. They use the US dollar as their currency. So they can't print money because they're using the US dollar. So they are serial defaulters because of that. How they approach defaults is almost as if they're used to it. They default so much that the public even doesn't take it very seriously, because they are so used to that. But in general, what we see is interest rates increasing, sort of currency depreciation. Those are the general things we see in that kind of scenario. But like I said, it's not so straightforward at all. It depends from country to country. If you compare Greece with Argentina, with Venezuela, it's completely different how things have played out for different reasons. So that's not an exact science.
Okay. I'm not too sure whether this is a long question or not, but someone wants to know whether you can explain about how a swap arrangement actually works.
A currency swap? So
yes.
yeah, there are different kinds of swaps, interest rate swaps, currency swaps. So essentially, in the case of an interest rate swap, which is not too common in Sri Lanka yet, our financial markets have a bit of developing. We are still a frontier market, and hopefully we will start getting into these different kind of derivatives going forward. But essentially, what a swap means is, now in the case of an interest rate swap, you have two parties where one party pays a fixed interest rate and receives a floating interest rate. So, for example, if you already have an existing obligation, let's say a fixed obligation, you have to pay fixed, let's say 10%, and now interest rates have dropped, and you want to convert this into a floating rate, you can use the interest rate swap to do that. So you can have someone pay you fixed, and you can offer to pay them a floating rate. So then their payment to you at 10% goes to your obligation at 10%, and now net what you're paying is the floating rate. So that's how an interest rate swap works. In terms of a currency swap, it's a bit tricky how it happens in the banking sector. It's a bit of a long explanation, but very similarly, you swap US dollars for LKR, and then what they charge you is the interest rate differential in theoretical terms, but it's a bit of a long explanation practically how that happens.
Okay, now there has been we have had a lot of import restrictions coming in. Okay, so as a government, we collect a lot of taxes from there is a substantial revenue coming in from border taxes. So by importing, by restricting imports, and there is a loss of revenue also to the government. So how can this be balanced?
Oh, that's a tough question. There's a loss of revenue. Yes,
I'm not talking about the practical things, but how theoretically, how does it work?
Look, that's a tough question to answer. How essentially, how do you manage the loss of revenue from taxes in that sense is the best approach is for the government to look at, over the last 4 years, you break down your tax, you look at which are the largest contributors. So in Sri Lanka, direct tax is actually not a large contributor, doesn't make up a large portion of the total tax revenue. It's indirect taxes. So whatever you lose on one side, if you're looking to make it up, I'm just thinking off the top of my head, the best approach would be to look where you can hit the most, where is the biggest pot, basically. So in my opinion, indirect taxes are somewhere you can make up that kind of loss. There's another question, Radhini, from Darshana on the opinion on reliability of inflation numbers reported by Census and Statistics. Is there another method we can apply to measure inflation indirectly rather than using official inflation figures? So I can't really comment on the reliability. I have no idea. But another method is, you can create your own index. How the inflation Colombo Consumer Price Index works is there's a basket of goods. They measure the price of this basket of goods every month. So if you create your own index, you create a basket of goods and you say, on average, a household in Sri Lanka consumes these and these things in these quantities. You create that basket, you measure those prices, you weight them accordingly, and then you measure those prices every month, and you add those prices into your calculation, and you weight it and make it into an index where at the start the index adds up to 100, and then going forward from there every month you keep reconstructing that index, and then you measure what the inflation is. You can do that, but inflation is a very tricky, Darshan, is a very tricky number. It's very hard to say this is the actual inflation. How do you measure the inflation? Your consumption is different from another individual's consumption. Their consumption is different from someone from another province. So how much of the consumption is Colombo? How much of the consumption is outside Colombo? That's a very tough thing to measure, but the approach would be to go about making your own index, attempting to.
That was a very detailed answer, I would say. Though you said it was not very straightforward, but I think that was a very, I think most of us can think of using something like that when you think the statistics, if you think the statistics are not reliable. So that was a very comprehensive answer, I would say. Another question, I'm not too sure how can we, this thing now, there has been a lot of borrowing in, or rather during the period of 2015 to 2019. So how has that turned against us, or as an economy, does it give a down or show a negative impact currently at this context with COVID also being there? Has it been, or rather, has it created a negative impact?
Okay, so I mean, it's no secret. Even the government has I think spoken on this. It's no secret that we are obviously under pressure to meet the payments of those borrowings. So, I mean, it's just like a company, right? If you're running a very leveraged company, highly leveraged company, in the case of a shock, in the case of a large unexpected shock, you run the risk of the company going under or the company going through a very tough time. So the country is no different. It's the same thing, and that's the same impact that it would have. But that's not to say that borrowing is a bad thing. It's just that I mean, the debt market is a normal thing in the global economy. It's just that you need to manage what you borrow, how you borrow, and how you use that financing in productive sources like you would in a company. It's very similar. Running a country, you can think of it in terms of how you run a company. So if you're borrowing and you're borrowing at a higher cost and you're borrowing large amounts, you probably have a expansionary thought process in the company, and you have a lot of projects that you think will give you a huge return, right? If you're taking those kind of decisions. So it's very similar to that.
Okay. Would you like to add any closing remarks, Shanara, before we move on to, if there are any other questions, I can take it after your remarks. Anything you would like to add at like a closing remark?
So I actually enjoyed this session a lot. I didn't expect this much interaction. I think it's a timely topic, so I'm glad that people are so involved in thinking about these things. I just want to thank you again. Thank you and the committee for inviting me. It's really I love talking about economics, so it's a good opportunity for me as well. So yeah, that's about it. Thank you very much for having me.
Okay. Thank you, Sanura. I think you're a very busy person, and amidst of your busy time, thank you so much for taking time and doing this session for us. And I'm sure you have given us a very good explanation on how the monetary policy and the fiscal policy works and everything. Thank you so much. And on behalf of the committee of the Young Chartered Accountants Forum, we would like to appreciate the time you've taken, the amount of efforts taken by you to do this session in a very timely, I mean, with the timely topics you have covered. I think whatever it's necessary for us. Thank you so much.
Thank you very much.